Welcome to our comprehensive guide on yield curves. Whether you're a finance newbie or an experienced investor, understanding yield curves is crucial. So, what exactly is a yield curve? The yield curve is a graphical representation that shows the relationship between interest rates and the time to maturity of debt securities issued by a particular borrower. In most cases, the U.S. Treasury. One of the most common yield curves is the Treasury yield curve, which shows the yields of U.S. Treasury securities at different maturities. Now, let's look at how a normal yield curve appears. Picture this. As maturity increases, the yields increase. This is because investors demand higher yields for longer maturities due to the increased risk. Here's a simple graphical representation of a normal yield curve. Why does the yield curve typically slope upwards? This is due to three main theories: the expectation theory, the liquidity preference theory, and the market segmentation theory. Let's break these down. According to the expectation theory, the shape of the yield curve reflects investor expectations about future interest rates. If investors expect rates to rise, the yield curve will slope upwards. The liquidity preference theory suggests that investors demand a premium for longer-term securities as compensation for the increased risk and reduced liquidity. Thus, the yield curve should naturally slope upwards. Lastly, the market segmentation theory proposes that the yield curve shape is determined by supply and demand within different maturity segments. Different investors may have preferences for different maturities, driving the yield curve slope according to supply and demand dynamics. Let's dive into an example of how you can use the yield curve in your investment decisions. Suppose you're considering two treasury bonds, one with a 2-year maturity yielding 1% and another with a 10-year maturity yielding 2%. If the yield curve is normal, sloping upwards, you might decide to invest in the 10-year bond to lock in the higher yield for longer. However, the yield curve is not always upward sloping. Sometimes it can invert, where short-term interest rates are higher than long-term ones. An inverted yield curve is often seen as a predictor of an economic recession. Let's look at the historical data. Here is a graph showing the U.S. Treasury yield curve during the 2007 to 2008 financial crisis. Notice how the yield curve inverted before the recession struck. Now that we've seen the inverted yield curve, it's essential to understand why this inversion happens. One reason is that investors flee to long-term securities for safety, causing yields on these securities to drop. So, what questions should you be asking when analyzing a yield curve? Here are 3 critical ones. 1. Is the yield curve normal, flat, or inverted? 2. What are the current economic indicators saying? 3. Should I consider short-term or long-term investments based on current yield curve data? Answering these questions will help you make better investment decisions. For example, if the yield curve is inverted, it may be wise to stay cautious and prepare for potential economic downturns. Let's dive into some frequently asked questions. One common question is, does an inverted yield curve always predict a recession? While it has been a historically reliable indicator, it's not foolproof. Market dynamics and external factors can influence outcomes. Another frequent question is, what are some alternative indicators to the yield curve? Besides the yield curve, investors can look at indicators like the leading economic index, LEI, unemployment rate, and consumer confidence index. In summary, understanding the yield curve is crucial for effective investment planning. We discussed normal and inverted yield curves, the theories behind them, and practical investment strategies you can use. Thank you for watching. If you found this video helpful, make sure to like, share, and subscribe for more finance tutorials. Until next time, happy investing!